sometimes when I sit down and think about what I want to write and talk with you in my market situation report, I have to really think about what happened during the week, both what was obvious and maybe not so obvious. And then there's other weeks, like this week, where it is very clear what the one thing is that we need to talk about. And the one thing that I think we need to talk about this week in the market situation report is Ben Bernanke coming out on Wednesday and talking about what he talked about, because it made the markets go crazy. And other than them going crazy, I learned a lot about how we can protect ourselves, what can happen if the worst will happen, where we can hide, where we can't hide, what really held up well, and what didn't. And so what I want to do is talk about his comments and then talk about what happened in the market so you can better kind of position yourself for what is for sure coming our way. So my general thoughts, my first big general thought is it seemed like the market read Bernanke's conversation as we will end money printing and it will end mid 2014. What he actually said was if three things happen or continue to happen, then we will take our foot off the gas pedal and slowly pull back until we are back to buying zero amount of U.S. Treasuries and mortgage-backed securities. But he said three things need to happen. He said the economy needs to stay robust. I'm using my own words. He said that unemployment needs to continue to go down. And he said that we need to continue seeing prices increase. So there were three things basically that he needs to continue seeing. And if he continues seeing those three things, then yes, he's going to start to pull back on the accelerator, start to slow down the money printing. But to me, it was like, if I see these three things, really, people, really, I will start pulling back if I see those three things. The market read it as, oh my gosh, he's going to stop printing tomorrow because he sees everything is great and our heroin is being taken away from us. But nonetheless, let's go with how the market saw or heard or listened to what Ben said. So what I want to know is who or what will benefit the most from higher rates? What companies or sectors or people will benefit the most from higher rates? I also want to know who will benefit the least from higher rates, so who will be hurt the most, both investments and people. And really, what did we learn basically from Wednesday till today? So the first thing we learned is when people panic, they still panic into the US dollar. Like the dollar, hate the dollar, you're neutral about the US dollar. When things get really, 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 really scary out there in the world, people still buy US dollars over any other currency in the world, in fact, any other asset in the world. So still the safe haven of the entire planet is US dollars, and you can see that on my screen with the red arrow. The red arrow starts at the bottom when Bernanke had a speech and ended at close on Friday. And the blue line is May 22nd when the word taper was introduced to the world. So one thing we learned is US dollars is still the place people panic into in the world. The second thing we learned, and I think what we really learned, is what will be most affected and the people who will be most hurt by money printing slowing down are people who own any type of investment vehicle that they purchase because of the yield or the interest rates they get from it. So I just picked one price chart. I could have picked municipal bonds. I could have picked 7 to 10 year bonds, 1 to 3 year bonds, 20 year plus bonds. I could have done preferred shares. But I picked TIPS because mostly people buy TIPS, which are Treasury inflation protected securities. Most times people buy these because the principal goes up when inflation goes up. So if you buy a tip at $100 and inflation goes up 2% that year, then that $100 will go to $102, but the yield on it does not change. So what you see here on the screen, and I didn't feel like I needed to bring any red arrows into this, but what you saw here is tips falling from 122 down to 110, which for something that is supposed to be very low volatile and very safe, about 10% was cut off this. So you're talking about 4 years, 5 years, depending on when you bought this, of your yield that was taken off almost within 6 weeks. So we know for sure that things that will get people or investments that will be hurt in the future is any investment that has a downside risk to increase yields, and that is all bonds, and it's also any sort of stock that provides a high yield. What's sad about this is people over the age of 50, 60, 70 have a lot of their money in high yielding instruments, and they probably are the ones that actually have been hit the worst over the last week and month, which is sad. Now, this is a price chart of the S&P 500. One thing we also learned, and I didn't need to bring up any other index in the world because everything did worse, or every other country index did worse than the S&P. But what we saw here was this announcement of just saying, hey, if things improve or continue to improve, I'm going to pull back on money printing, as he should. What you see here on the screen is that the stock market broke down. This is what I consider breaking down. It broke below very strong support points, and it just broke down. Now, the reason this was important to me is because what I wanted to do, and then what I did do, was I went out into the world of investments. I looked at stocks, I looked at ETFs, I looked at closed-end funds, open-end funds, mutual funds. I looked at almost everything I could. I looked at thousands of price charts. And I wanted to find out what didn't go down. Because if something didn't go down, that means it's going to like if interest rates go up. In fact, they can benefit, that sector, that industry, that company can actually benefit for interest rates going up. And so after looking through many thousands of charts, I found three. I'll share with you two. Both two are in the same main sector. And the point of me telling you them is that there are places to move your money. Now, both of the places are in financial services, and financial services is a very large sector. Now, to be fair to my paid clients, I can't reveal the subsector, but financial services has, I don't know, a half a dozen subsectors. But I am giving away the main sector, and both of them were in financial sector. So notice here how it did not break down. Yeah, this price chart went down a little bit, but notice that it still stayed within its range. I mean, to me, this is staying within its range, and considering that most things completely threw up and broke down, the fact that this sector, this subsector of financial services didn't break down was really important. Then look at this other one. This is another subsector of financial services. I know it may look almost similar, but notice how this didn't break down at all. I mean, it just kind of consolidated a little bit here. It didn't even break down at all. That means this other subsector of financial services really wouldn't mind having higher interest rates for their sector and for all of their businesses. And this is what I learned most from basically Wednesday till Friday at close is where are the sectors that will benefit the most? And I found two subsectors within financial services. And so what I want you to take away is there are places to look, and those are the places that will benefit from higher interest rates. So the question you want to start asking yourself going forward is, where can I put my money? Or what companies benefit from interest rates being increased? Now, the takeaway from everything is you want to have your money in a strategy that can adapt to what's going on. There are strategies, I use them, I teach them to people, where they will adapt for you and tell you what to put your money in, because ultimately the strategy determines your outcome, not the ticker symbol, not the sector, not the asset class. Yes, I identified two subsectors for you, but it's still the strategy that tells you how to buy, how to own, how long to own, and if they move against you, how do you manage that loss? This past week, I did a really in-depth conversation, basically that was all around how to invest without central banks. And of course, I didn't know what Bernanke was going to talk about on Wednesday, but if there's anything you do want to watch this weekend, it's probably this this conversation I put together. It's about an hour in length. It goes into detail of what you can do with your money, how to protect yourself, and I will send out a replay email for you this weekend. Hey, thanks everyone for being here. You have a great weekend, and I will speak with you soon. Take care.